All right, Corvin. Thanks so much for joining us today. How long ago was it the last time you and I talked? When was that?
We had one in December. Hey, I
Okay.
get to see you face to face. I didn't see your face last time. Good to see you. How
All
you
right.
doing?
Well, Happy New Year to you, Corvin.
Thank you very
So,
much.
all right. So we just wrapped up the first quarter. A lot of interesting moves. First, in the S&Ps, we had the worst start in stock market history. Then we had the sharpest rebound since 1933. A lot of people came into the year still bullish the dollar. That's been trying their patience as shorts continue to get squeezed in the euro. What do you make of what's happening here? And seems to me like a lot of the omnipotence of central bankers is being chipped away. Draghi comes on, wants a lower euro. It rallies 400 pips in his face. Yellen tightens in December, and now she's flying around like a dove. What do you think of this environment? Is it tricky?
Well, it's exciting for starters, and the good thing is you have volatility, which means that you have opportunity. I mean, if you wind the clock back just a couple of years, 2013 and 14, when a lot of things, at least in the currency markets, didn't move, it was quite frustrating. I think at the
Yes.
moment you're seeing, trend followers making substantial amounts of money throughout the start of this year, particularly on the back of these kinds of moves. And so my focus are the FX markets, and certainly from that point of view, it's been very interesting. As you said, euro dollar at the start of the year was at 105, and it's all of a sudden at 113. Especially with Draghi indicating that they're more or less at their lower bound for negative rates, and Yellen all of a sudden saying that, and she's not quite keen to hike as aggressively as before. All that short euro position is going to be unwound. I wouldn't be surprised if this thing actually manages to go up to 120 over the next couple of months.
Interesting. So this time we're going to do something a little different because we're going to screen share because a picture speaks 1,000 words. If you go up to the upper left-hand corner, you'll see a green box with an arrow.
Got you.
And you click that, and then you'll see different desktops pop up after you click it, and then you could show us your screen. You click on the.
Okay, let's try. So will I see what I share? Okay, so
You should, yeah. Okay, so here we are. We have a naked chart using green candles of the daily Euro USD.
yes,
So
that's right.
tell
Actually,
us
yes,
what
I,
you
I
think.
wanted to talk through. I wanted to talk through a couple of instruments today. You suggested that as well. Before I
Okay,
start doing that, I wanted to just sort of lay out what my approach to the markets is, which is probably slightly different than technical analysis on a very short-term frame. So I'm going to pull up
okay,
a PowerPoint. Can you see this?
yes.
Okay. So, aha, but you. Okay. Well, let's
No,
just keep it
a
like this.
total FX benchmark is showing
Yeah.
in the
Okay.
middle.
I've got the slideshow on my right screen. Well, it'll be big enough. Let me zoom in. Let me zoom in. So this is really what the picture is. So this is essentially a trading approach to FX. It's very subjective. It's rule-based. It's back-tested on data, interest rate, and currency data all the way back to 1991. So what's the purpose of showing you this? Currencies are really driven by several factors. So in equity markets, we know that value stocks tend to outperform growth stocks on average. You have that smaller companies outperform bigger companies, and you also have momentum-driven stuff. So, what are the factors that drive currencies what are the factors that drive currencies? And there's really three factors here. One of them is interest rates, interest rate differentials. We already broached that subject with regards to euro dollar. So Draghi, as a central banker, and Yellen will have varying policy adjustments they must implement, and that will, of course, will affect the way people reprice euro dollar, for instance. So what does interest rates mean in particular for currency markets? It means that people tend to chase the high-yielding currency versus the low-yielding currency. So a classic example used to be Aussie versus the yen. People tend to buy the Aussie over the yen because Aussie yields 2.5%, whereas yen at the moment has negative interest rates. So just by holding Aussie yen, even if it doesn't move, you're making 3% annualized without any leverage. Obviously, if you use the kind of leverage that people tend to use in the currency markets, you can make much more. The
So
other
is this
factor,
what we're looking at right here, Corvin? Is this your performance, or what does this represent, this chart that I'm looking at here from
So it
1994
represents the performance. It represents the performance of a set of strategies that are driven by fundamental factors. So one of them would be interest rates. So the interest rate approach to currency markets flows into this chart. And I'll go through the actual subcomponents in a second. So besides
are these trading programs that you use? This is your result?
No, obviously not going back to
study.
1991. Not going back to 1991 because certainly I wasn't around at that time. This has been traded from 2007 towards the end of 2000 or middle of 2009. Certainly the performance afterwards again is backtested because ultimately when I was running my fund, I was very much intraday trading, intra-week trading probably 100 trades a week. My focus, however, has now gone much more long-term. I don't believe that people who sit at their desk and don't have access to infrastructure will be able to achieve performance on an intraday level that maybe funds with the technology that they have at their disposal can achieve. And so really the ultimate question comes, what does it mean to generate long-term growth? Do you have to follow every news announcement? Do you have to follow every intraday move? And the answer is no. The answer is that if you actually look at a very simple set of rules and factors that drive the currency markets, you can generate long-term performance. And it's underpinned by economic factors. And that's really what this chart represents. So I'll start out with, so we covered interest rates. So as a classic example, so at the moment, the biggest interest rate differential, so if we bring up some charts, at the moment is between Kiwi Swiss and Aussie Swiss. So the great thing of going about looking at the various factors that influence the currency markets is you tend up looking at currency pairs that a lot of people don't look at. So if I bring up something like Aussie Swiss at the moment, as you can see over the last month, it's been sideways, range bound, and most likely going to continue staying in that range. Probably going to bounce up, but two things are going to happen here. Not only are you earning 3% annualized just by holding this currency, but by trading in the short term around it, you can obviously exploit the upward move that is natural in the trend at the moment. So we obviously are, at least over the short term, the last 2 months, in an upward trend at the lower bound of this short-term channel. And just by holding this currency, you're making money on the carry, and at the same time, you're going to also exploit the move that you can see moving upwards. So that's the purpose of that benchmark. You understand what the underlying fundamental factors are, and you can therefore really help your shorter-term trading because that benchmark is only rebalanced on a monthly basis. Obviously, you can trade over a week or over 2 weeks that particular currency pair. Another example of a high interest rate difference currency pair at the moment is Kiwi Swiss. If I bring up the Kiwi Swiss chart, you've got the same situation. It's at the moment bouncing in the 400 pip range, and it has been doing that actually for months now. So that will most likely continue. But just by holding this currency, you're earning 3% annualized. So if you trade as most people do,
which is a big deal in a zero to negative interest rate environment.
Pardon?
Which is a big deal in a zero or negative interest rate environment. A 3% yield is pretty good.
Well, exactly. So at the moment, Kiwi's yielding something like 2.5, 2.6%, and the Swiss actually giving you minus interest rates, minus 0.75 at the moment. So the difference between this is actually 3.5%. So as with most people, you know, if you're probably trading this kind of stuff at, let's say, 5 or 10 times leverage, that means 30% annualized, at least over the month. It means between 3 and 4% that you can make on your account. And if you trade around the ranges that are forming, you can get an added kicker just by trading the range at the moment. So it's always important to understand, you know, what other factor besides just the actual spot move is driving this particular pair I'm looking at. And therefore, the kind of approach to looking at factors like that, it makes you end up looking at currency pairs which other people usually don't look at, such as, for instance, the Scandi pairs, dollar NAKI, and we'll come to that in a second as well.
Okay. So this is an institutional, this is pretty much an institutional approach to the FX markets, where they're retail traders, you know, unless they have sizable accounts, that 3% should appeal to them, but it doesn't appeal to them.
Well, no, but that's with one-time leverage. Now, who actually in the retail space trades on one-time leverage, yeah?
Right. Good point. But a very interesting approach.
So obviously if you increase your leverage and you get the entry points right, you get a double whammy. You get the interest rate differential that gets debited to you, credited to you, and of course you get the added benefit of the spot move.
Okay.
So that's really one factor. It's about interest rates. The other factor is the value factor. So here's actually that subcomponent of the chart I showed before, which just looks at what happens if I were to only trade value in the currency market over the last 20 years. So value is an interesting idea. Value comes from the fact that imagine you go to I go to the States on holiday and I buy an Evian bottle. Yeah, it's a French manufacturer, bottles it up in a plastic bottle, sticks a label on it. So I bring this bottle unopened back to London, but guess what? In London, in the newspaper stand, there's exactly the same bottle over there. Yeah. So I could effectively swap these two bottles against each other. Nobody would notice. Now, let's say I bought that U.S. bottle for $1.30, and the London bottle I bought for £1. So the effective exchange rate should be $1.30 to the pound. But then I look in the market, and I see in the market it's quoted 145. So the market, in some sense, is overpricing sterling compared to what it actually is, and so it naturally lends you to sell sterling. So that's how you can establish a value. Now, obviously, you don't have to go and look at the price of goods in every country. You can easily look up what these good-based prices for exchange rates are at websites such as the IMF or the OECD if you look up the PPP values. And then the idea is to find the most undervalued currency and the most overvalued and trade one against the other. So the example, for instance, recently has been on two currency pairs, the Euro Swiss and the Aussie CAD. So Euro Swiss actually, forget about it, this drop, of course, was extremely interesting after the SMB decided to remove its floor. But ever since then, you've seen that Euro actually at the moment is the most undervalued currency across the majors, and Swiss is the most
I know these events like the S&P coming off the peg are exceptions, not the rules. But if you had been executing that strategy going into it, would that have been a huge hit?
Well, actually, no, because you see, it dropped by something like 20–25%. That wouldn't have been on your radar because Swiss at that time was massively overvalued as it is presently. So you wouldn't have traded the Swiss. And of course, people tend to be a bit Swiss because of this kind of potential intervention, but this requires some nimbleness on your feet and being able to understand what the markets are doing. I mean, let's wind the clock back to the Euro Swiss situation, and you can definitely see where the floor was at 120 for these people. Right. By trading something that's floored and that's pegged, you're always effectively selling optionality into the market against such a massive move that's going to happen to you. So you are very well aware of the peg risk that exists. If you should be willing to take that peg risk, then that's part of the risk management process. The whole point, however, is back then in January of 2015, the issue wasn't that you would have even looked at this pair because overvaluation didn't exist at that time for the Swiss franc.
Got it.
However, if you actually look at what happened to the Swiss franc ever since then, it's been selling off quite nicely versus the euro. Euro Swiss has been appreciating, and that's another way that you can exploit it. And so, for anybody who is a fan of chartists, you obviously at the moment are looking at this thing being on this trend line. You understand that from a fundamental factor, the trend is up, and so this would be a good entry opportunity for Euro Swiss to see it go all the way up, maybe to 112, 113 over the next 2 to 3 months.
Okay.
Actually, another example in terms of overvaluation, undervaluation leads you to another interesting currency cross, which is the Aussie CAD. So with obviously the CAD move that we experienced in dollar CAD due to oil over the last year, CAD has become actually quite undervalued. And even now that it's reverted, it's still undervalued, quite undervalued compared to the other currencies. And that leads you to something like the Aussie, which is still actually overvalued, even though it's declined so much. So being short Aussie CAD, actually, from this valuation perspective, is one trade that this portfolio recommends. And interestingly, again, rather than just trade the portfolio naively, look, I'm being told Aussie CAD is great because Aussie is overvalued and CAD is undervalued, and being short Aussie CAD, I can look at the technical setup, and as you can see, it's bouncing against resistance at 1. It's now at the moment around about 99, and it looks like an opportune moment. You can always put your stops in really tight. It hasn't been this high now for something like 1.5 years. So the downside is actually much more likely, and you're being given fundamental reasons as to why you should be short Aussie CAD at the moment.
And what is there a yield differential in your favor on that?
Well, in this particular case, now that's an interesting question. CAD actually has quite low interest rates at the moment. Aussie has quite big ones. So in this particular case, the interest rate differential would work against you. But now that is actually quite interesting because obviously let's say you've put on the Aussie Swiss position we talked about previously. You're at least what you're doing is you're managing to cancel one out versus the other from a portfolio perspective by trading long Aussie Swiss and short Aussie CAD. At the same time, you're getting the benefit of the added directionality that you can infer from the charts.
Very interesting.
So this is where it becomes interesting because a lot of people tend to only look at one currency pair and try to have a system on the back of that. What I'm really saying,
you're a portfolio manager of currencies.
Precisely, and that's in the end how you can extract the value and get the smoothness of your returns. Because if you're always stuck to only one instrument and maybe one or two systems, guess what? You're going to be hit at some point in time, and the pain can be much bigger in a situation like that when you're very focused, rather than when you're more spread out across different benchmark, different currency pairs.
What a great! I'm so glad I invited you back because we really haven't had a presentation like this, looking at the whole currency complex as, like you were talking earlier, like growth stocks and small caps and how to take advantage of over and undervaluation rather than just making directional bets.
Well, actually, interesting you said directional bets because obviously the other one, besides just interest rate differentials and valuation, we still have momentum, especially in the currency markets, and you can't overlook that. I mean, why do you think trend-following funds are so successful? Because trends do exist. I mean, you can explain it sideways that you have crowd behavior and herd following and all that stuff, but the point is it does exist and we can observe it, and so obviously that's another factor that plays quite deeply into the portfolio construction I'm talking about, and that probably can pique some people's interests in terms of what I'm going to present now. The key here is it's not short-term momentum. It's momentum as you've observed it over the last 3 months. It seems that 3 months is kind of the optimal period over which to look at momentum. And obviously, the big loser or a loser against the dollar over the last 3 months has been sterling. It's had some phenomenal moves. And at the same time, the big gainer against the dollar has been yen. I mean, that's a phenomenal depreciation of something like 10% over the last 3-4 months. So if you combine the two, of course, sterling yen, the last 3 months had the best, something like 15% decline. Had you been on that trend, that would have been phenomenal. And certainly just looking previously at the momentum that you observed, you would have actually captured the last 2 months of momentum. So the whole point about momentum is you believe the trend will continue. So looking or taking sterling yen, the portfolio would actually want to put you into short sterling. And this is what I call a puke trade at the moment. Why? Because naturally, you're looking at this thing. It's already come down from 195 all the way down to 160. It looks like it's bottoming out, and a lot of people would just not have the guts to put this trade on. To be quite honest, I'd be very scared to put this trade on as well, and so the question is how do you manage it over the short term? But certainly part of the portfolio says you should put on sterling yen to the short side and let it play out over the next month. Most likely it will decline. Of course, momentum tends to be amplified by catalysts in the market, and the great thing we of course have at the moment for sterling is this Brexit story. And as more polls are coming up and as more people are realizing that actually getting out of the European Union is quite likely, you can imagine the hysteria that's going to fall on the back of sterling and the pound being completely smashed probably into May and June as the elections come up.
Do you think there will be a Brexit? Most people are poo-pooing it. You think there will be?
Well,
would one more terrorist attack in mainland Europe seal the deal? And isn't that why polls are moving in that direction?
I think that's part of it. But what's interesting, you see, I actually live here in London. Obviously, I'm not from England, but you get to meet a lot of English people and ask their opinion. You tend to find that the foreigners or the European citizens who work in London, they obviously have a preference for England to stay in. But it's not up to them, it's up to the English people. And really the perception here is that why should we be part of a political union where we seemingly spend subsidies or have to pay subsidies every year in large amounts. We have no control over our political environment. There was this human rights bill that essentially is being run out of Brussels rather than England, et cetera, et cetera. It's this idea of identity, nation identity. And I'll tell you the really scary thing is, for some reason over the last 10 years, I think it's really kicked off with this war on terror in 2001, the world has become much more inward looking. You know, every nation wants to be its own master. This idea of open boundaries and open borders, on paper maybe, but in reality people really don't want that. And boundaries are going up again. I mean,
the rise of nationalism.
No, completely. I mean, just look at Donald Trump. I mean, God knows if he's going to win or not, but he provides us overseas with endless fun.
Okay. All right. So go ahead.
No, and the only thing I just wanted to add was in Europe you can definitely see it. No, I mean the Basques want to separate from Spain. People want to shut their borders to migrants because of the influx from the Middle East. So would I be surprised if England exits? Not at all. I mean, I think it would be, even according to the polls, if you adjust the polls by the likelihood of people voting, the polls are very much in favor of leaving.
So it could end up being the pound selling off, sell the rumor, buy the fact into the event.
It could be. But here's the really scary thing. If you actually wind the clock back on sterling all the way back to the 1980s, at one point there was a parity. It was like a 105 versus the dollar. So could it go that low? I mean, there's a definite possibility. So trading sterling right into the last month or two before this June 23rd election referendum, it's going to be a tricky business, and people should really be on their feet and nimble to see exactly how to trade that market.
Or not trade it at all.
Or not trade it at all, but yeah, it depends on your position.
Yeah, that's always an option, isn't it?
It is. Well, talking of momentum, we briefly mentioned Eurodollar at the beginning of the show, and one of the things that is interesting is if you bring up the Eurodollar chart again, it was at 105, it's now at 113, 114, and that's really driven off central bank policy. And if you actually wind the clock back and you sort of zoom out, you're now actually at exactly this kind of range prior to which you collapsed into at the start of 2015, especially on the back of this quantitative easing out of Europe. And as people realize that the European Central Bank might be done with, or is done with, negative interest rates, and God knows how many bonds they can really buy up, and that Yellen might not have the heart to really hike up interest rates anytime soon, you're going to have an unwind of this. So momentum is not just about what was the biggest momentum in the past, but what's starting to amplify going forward. And one of the biggest momentum factors that is increasing at the moment is on Eurodollar in terms of acceleration. So that's going back to what I said before. I can definitely see Eurodollar going to 120 over the next 3 to 4 months. I think a very good indicator will be how it behaves this month if it manages to break above 114.50 and stay there with definite support, and I think that's a great trade to look forward for the rest of the year as it does go up back to 120, 124. And interestingly, its fair value according to purchasing power parity, so this idea of valuation of goods, is at the moment according to the OECD at 124. So euro is still massively undervalued, which was the reason you bought it versus the Swiss franc. But even in the case of the euro,
just call this a rectangle. And let's call it 1,000 pip range between 104 and 114. Just a measured move gives you 124, which is purchasing power parity. Is that what you're saying? It is?
Yes. Yeah.
Okay, so you have a fundamental argument and a technical argument pointing towards the same outcome.
Now, of course, I mean, the most interesting thing is going back to sort of technicals or chart patterns. This is here clearly a double bottom. And as far as I can, or I understand, if I understand this correctly, this kind of setup usually indicates that the market really has no desire to move any lower on this, and that the upside is definitely there to be had.
And I think there would also be some type of fib retracement up there, maybe halfway back from the 140 slide, something like that. Okay, well, yeah, a lot of confluence pointing towards the same outcome.
Definitely, it's beautiful.
Okay.
Now, obviously, it's not just about the long-term influences on the currency market, so the 1 month, 3 month, 6 month influences. It's also on the short-term side. On the short-term side, mean reversion on currencies plays a big factor. And currencies aren't like Yahoo stock that starts out at 10, goes to 100, and comes back down to 10. You know, they tend to oscillate heavily in given ranges, and that's the nature of the beast. You know, you're not going to wake up one day and all of a sudden Eurodollar is going to be priced at 5 or at 10. And you can definitely test for that, at least from a statistical perspective. But I wanted to show you a strategy with regards to mean reversion over the weekly time scale. So this is effectively what this chart shows you is if every week you'd gone into the market and you'd sold the most trendy currency of the previous week and bought the least or the one that went down the most. So it's like you're mean reverting. So you're selling the best performer, you're buying the worst performer. So in this particular situation at the moment, we'd have sterling Kiwi. So sterling was the worst performing currency. Kiwi actually was the best performing last week. So sterling Kiwi as a combination was the worst performer last week. And it already has posted quite a big bounce. So for people who are interested in much shorter time horizons, looking at that combination, looking across all possible currency pairs and identifying what's gone the most last week and then trade against it, that's a viable strategy that can be quite successful. Okay. So in this particular case, it was sterling Kiwi, going long Kiwi sterling at the start of this week, so just the last 30 to 15 hours. And the previous week, actually, it was sterling Swiss. So I'm going to give you an example here of what it means to trade very simple rules. Trading very simple rules means that you can overlay them with your own understanding of the market. So the previous week, sterling Swiss was the worst performer. It did bounce into midweek, but then it sold off again massively towards the end of the week. So the idea of imposing your own stop-loss mechanisms on a portfolio approach means that you can definitely outperform the portfolio. So it's like, you know, the equity traders will look at the S&P and say, I can do better than the S&P. So that's the whole point about having an FX benchmark that's made up of really, really simple rules, because then you can ask yourself, how can I perform? How can I be better than this? And if this is already tremendously good, it means I'm starting from an advantageous position. So imagine a guy who's just looking at moving averages on currencies. He has no clue if these moving averages would have made money or wouldn't have made money. The whole point about starting from an approach that's worked in the long term is you're starting from somewhere already in the plus. You don't have to worry about this thing working that, and you can just worry about outperforming it rather than, you know, hey, am I making any money at all here?
Interesting.
And I think in terms of mean reversion, currencies don't just mean revert over the very short term, they also mean revert over the very long term. And that actually brings you to an interesting, I like the Scandis. I like the Scandinavian currencies, Swedish krona and Norwegian krona. And I know that a lot of people might not look at that, but they're fantastic currencies to trade if you have more capital. And the chart I'm bringing up here actually is a monthly chart of the Norwegian krona. And it's looking at the 50-month moving average. That's the yellow line over here. Yeah. And in essence, what you're doing is you're going across all your currency pairs, and you're looking which currency pair is the furthest away from this moving average. And I'm just going to trade it the other way. So in this particular case, dollar NOK is the longest away from its moving average to the upside. And so a great thing to do would now be to short dollar NOK. And there's actually much more interesting fundamental reasons for that. Dollar NOK, if you actually look at the 20, 30 years of this currency, which I don't have here on this chart, you'll see that it's more or less at its all-time high. The all-time high is actually the upper boundary I've marked here at 980. It's, you know, this at the moment, as far as I can tell, will be a one-way street, right down all the way back to 6, which is around about 2,500 points.
Wow.
So managing that short side would be very profitable.
Okay. What a, you know, hullabaloo of great ideas and interesting approaches. How do you combine all of these? How do you combine all of them in a portfolio? Is it difficult to have all these different strategies working for you at the same time, or are there times when one is more advantageous to be in than the other?
It's, in the end, it's all about, I mean, I run this off a spreadsheet because, you know, I don't have to be on top of it every minute. I look at it at the end of the week, and that'll more or less put up what positions I should have. And then, as I said, I mean, I've done a lot of intraday trading in the past, so I do have that kind of bias. I will actually check if the short-term technicals do coincide with this longer-term view, and then I'll put the positions on with appropriate stops where I think. But it's really just about creating a benchmark portfolio for the week. So every system will say, go short dollar Naki, go short Aussie CAD, go long Aussie Swiss. In the end, you bring up the charts. Should I do that? Shouldn't I do that? Where are my stops? And I just run it for the week and then see what happens. And I rebalance at the start of every week or every 2 weeks. So from an implementation perspective, it's straightforward.
Okay.
I suppose. I mean, I like talking, and I like talking fast. So I apologize for the fact that I think I've steamrollered you. And there's
the advantage is it's recorded. There's so much information in this interview that I'll have to go back and play it again. But that's the advantage of having this recorded. This was a great presentation and unique and unusual presentation from what I normally get. And you've broken down so many different trading philosophies and styles and rationales behind them. It was really a great interview, Corvin.
Thank you. I mean, I think, do we still have time, or what's?
Yeah, sure we do. We have time.
I mean, I suppose one of the things that I haven't done here is, because I think right at the start you mentioned what happened in the equity markets, for instance, and I certainly what happened in the commodity markets. We haven't really broached that subject at all. But what's interesting is, I don't know how many of your viewers look at ETFs. But there's one great ETF out there, which is the iShares U.S. Aggregate Bond Index, run I think by BlackRock, used to be Barclays Capital, and prior to that Lehman Brothers. But if you just bring up a chart of that, that's like, you want to get rich quick, just like buy that thing, leverage it, and run it for the next 10 years, and you're going to make $1 million out of 10,000. I mean, it's just such a wonderful instrument. And the reason for that is, there's been a tremendous bull market in bonds. It's not just made up of government bonds, it's made up of other credit bonds and mortgage bonds, and they're going to provide value. But the underlying idea about this aggregate bond index is if you start to combine bonds with equities, even in very simple ways, you can really get a kick out of your portfolio. So how does FX come into this? Well, now you have an FX portfolio that you can actually, with pencil and paper, validate that it works, and you can stick it to your other asset classes. So for people who have a broader view of the markets, the bond market, the equity market, now you have a way of approaching the currency market, which isn't just an exchange rate I have to look at when I go to another country to visit for tourism. I can actually use it to create value over the long term, and that's really the approach that I advocate and that I implement, because you need to have a rationale as to why to trade an asset. People buy houses because they know house prices are going to go up, or they can get rental yield off them. So why the hell would you want to buy or invest in currencies if you don't have a long-term perspective on the back of that? Because the short term isn't going to make you money. I mean, I think there's a famous saying here, if you're only looking to invest over a 5-minute holding period, you're not going to make money. The money's really made by just buying something and holding it and just seeing it go to the sky.
Since you touched upon it, any views on what's happening in the commodity complex and the equity complex? We have that worst start and then a huge rebound. Do you think risk on continues for equities? And I know a lot of global bourses are well behind the U.S. performance and recovery. Do you have a view on that, and does it affect your outlook on your FX programs?
Well, I think you mentioned it there. It's in terms of risk, and risk on and risk off. And of course, the S&P goes hand in hand with the VIX, with the volatility index. And the volatility index tends to be observed by many people, not just for equity markets, but for other markets as well. And that definitely does play into the currency market, because when you get heightened volatility or a heightened fear of risk, a lot of strategies will get hit. Like a carry strategy that lives off making interest rates while times are quiet will get hit when times are turbulent. And so it's good to have a view on what your other assets are doing, which represent risk. I mean, the S&P at the moment, it's done phenomenally well, but you still have that massive barrier 2,100. So are you going to overcome it? What's the catalyst that's going to push you upwards? I mean, I can definitely see that currently it's a combination of the fact that interest rates are not going to get hiked as fast, and that you're getting, okay-ish unemployment numbers out of the States. And so both these factors probably driving equities high, but can they drive them higher is the real question. And so as long as it doesn't go above 2,100, I just, probably my bias would be towards the short side.
Okay, however, and how about gold? How about gold that had its best quarter in I don't know how many years, which is a currency into itself, and a lot of people were bearish gold because of the opportunity cost of yielding zero plus carrying charges storage. But now that we've moved to zero rates or negative rates, that opportunity cost in owning gold has gone away. Gold figure into your overview?
It's well, I have a view on gold. It certainly doesn't figure into this portfolio construction per se, because I think gold is pretty much a universal currency. So to whom do you attribute it to, and what kind of sort of specific country factors can you associate with it? I think, look, gold has always been an inflation hedge. So if gold moves up, you got to ask yourself, what's the perception people have about inflation, and is all this money that's being pumped into the economy going to add up to anything? But that brings you to a completely different story. If inflation isn't perceived to go up, what does that tell you about how the economy is going to grow and people's outlook on risk assets such as equity markets? If equity markets will stall, aren't going to go up higher, or they're going to sell off, if all that money in the economy at the moment isn't going to feed through to small to medium sized enterprises and consumers, it's just going to be stuck in limbo, and people are not spending, and inflation stays down, it could be, a very nasty situation, which gold probably will continue to go to the upside. That's sort of a very high-level view, but as I said, gold is not the biggest of my focuses with regards to the instruments I trade.
Okay. So I know you have a course because your handle is FX Master Course. So
yeah, it's not the most creative handles.
Excuse me?
It's not the most creative of handles.
Okay. Well, but it does accurately say what you have. So you have a course. Do you also manage money?
I have until I have up to the 31st of December, at which point I exited my fund. The fund is still being run by my business partners, but I myself have now fully retired from that and managing my own money and focusing on education.
Okay. So besides the course, why don't you tell us a little bit about the course and how you teach it, what's the environment? Tell us a little bit about your course.
Well, I think in this interview, really, you've seen a high-level approach in terms of identifying the factors that drive currency markets, creating portfolios, and tactically trading around them to outperform the benchmark. That's really what I teach in a nutshell.
Okay.
By several factors. One of them is, in running my fund and my systems, we would trade something like 100 trades a day. And one of the things that you tend to find in that kind of situation is that you're very constrained. You're technology constrained, you're liquidity constrained, and you have to be on top of things all the time. And trading ultimately should lead to freedom and not another job to stare at the screen. And that also then translates into taking a long-term view. Talking of which, I can tell you some very funny stories about high-frequency traders at banks or high-frequency firms who are probably not high-frequency in their life. I mean, some of them take something like a week to decide which restaurant they want to go to meet up for dinner. And I think it's that kind of long-term approach that in the end makes you a lot of money. I mean, all you have to do is pull up a chart of Berkshire Hathaway to see where I'm coming from. Because ultimately, once you have a very sort of straightforward methodology, you can then start to think about leverage. And that's really the added component of the course. What does it mean to manage your money properly once you have an edge? Because you see, as a hedge fund guy, why do you think somebody comes to you and invests with you and pays you 2% management fee if he can do the same thing just by buying a bond index? So if he comes to you and he says, what do you do? And you say, well, I take the long-term approach and I do sort of very straightforward portfolio construction, he's going to say to you, well, I'm not going to invest with you because I want magic. I want hocus pocus. I want, neural networks and wavelets and God knows what. That's sort of the pressure hedge funds live under. But as private investors, we have the opportunity and the luxury to exploit any edge, no matter how simple and straightforward it is. And within the FX markets, that's the thing I presented, and that's the thing I teach in a very methodical way, so that anybody, regardless of kind of numerical background or not, all you have to be able to do is put a number in the spreadsheet to see what comes out. And I take you by the hand because the purpose is to create a framework of thought about the markets. It's not just sufficient to say, well, here are the rules, follow them, and that's it, because the markets change. So if you understand why the rules are motivated, you can change your approach as well. And ultimately, what I'm really trying to get out of people is for them to think about the underlying factors that drive the markets, be able to identify them in an objective way, and then be able to exploit that to create, hard and fast black and white portfolios that generate long-term growth, and then use the leverage to really kick it out of the ballpark.
Thank you so much for your time today. I really enjoyed it. I'm going to be replaying your interview, Corvin. Let me ask you this. With your kind of strategy, what kind of equity do people really need to make it worth their while to take your course and execute what you teach?
So I really believe you can double your money if you use the right leverage and the right risk approach within a year. Do I believe you can double your money within a month? Well, if you're lucky, yes, but you're also going to go to the poorhouse very quickly. But here's the other issue. If you start with $1,000 and you double it, you have only made $1,000. Now, on a percentage basis, this is going to sound really remarkable, but in nominal terms, notional terms, it's not going to be neither here nor there. It's just not going to be interesting, and the motivation wanes. So what I say to people is, even if you start with $1,000 or $5,000, you should see your trading account as a long-term investment, where like with a 401k in the States or an ISA here in England, you keep on topping it up with cash so that your growth accelerates. Because ultimately, you're going to have real fun making money when the money you make is $50,000 or $100,000 in a year. If all you're making is $1,000 or $2,000 a year, it's not going to be fun. So the amount of capital you put in is going to be directly proportional to the amount you take out. So it requires really a certain mindset to be able to understand that psychological conundrum and to be willing to work at it and keep on investing in yourself. And the act of investing in yourself, sticking to the rules, will make you wealthy, but it requires that discipline. So yes, you can start with as little as $1,000 or $5,000 because we have these nano lots, and the FX market is phenomenal in that respect. But if you really want to make money, you have to come at it with significant capital. But as I said, you can grow that, and it's about discipline and commitment to make it grow, which you can definitely do.
What do you charge for your course?
Well, actually, I'm launching a live webinar series next week, and if you sign up to my newsletter, you'll start getting a series of emails explaining what it's all about, and that's priced at $897. It'll be 8 weeks with me, 2 hours a week, where I will have 1 hour every week of covering the material and 1 hour of Q&A, and follow on in terms of helping people set up their stuff for those who want to one-on-one calls. And the idea is not just to sell this webinar series, but also to set up a community, a group. So again, in terms of the long term, once people come on board, I will be running the portfolio so that they can see how it's managed. At the same time, they can copy and implement. But we really support each other as a tribe, as a network, to see each other grow wealthy. So if you want to, it is a hedge fund, but it's a completely decentralized hedge fund where people manage their own money, but you have a forum in which you can discuss, you can learn new ideas, and you can support each other. One of the things I found with people who trade for themselves, and especially myself and my fund, it's a very solitary enterprise. You don't have other people whom you can talk to. I know you've got these trading rooms, but the issue with trading rooms is it's like hot houses. If you don't perform, you haven't made a trade in an hour, and you haven't made money, oh my God, it's a catastrophe. Here it's really about talking to each other to create a support, a bedrock, so that you can exploit the long term and, in the end, hopefully build relationships that last for a long time.
Yeah, and you have to be patient, and waiting is the hardest part.
But if you wait in the group, now obviously I'll be sort of the core of this community for this at the start and really support people. Then that's just a great environment to be in.
Well, you're preaching to the choir when you talk about the strength of being in a community. So I'm a big believer in that. So I wish you a lot of luck on this new series, and thank you so much for your time today, Corvin. Good luck and good hunting, and really appreciate you showing, tying in fundamentals with how to pull equity out of the market by taking advantage of these different modalities that you showed us today.
Thank you very much for having me on the show, Dale. I really, really appreciate that.
All right, partner. Good hunting. Everyone thank Cordirla for his time today. You could follow him at FX Master Course. Do you have a website address you want to throw out there?
Yeah, the website is fxmastercourse.com.
Okay, I could have guessed. All right. Thank you so much, Corvin. Good hunting, buddy. And talk to you soon.
Take care.